Hi traders, Gavin McMaster here from Options Trading IQ, doing a video collaboration with Barchart. Today we're going to be talking about options Greeks and going through everything you need to know. Just before we get started, a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So in today's video, we're looking at option Greeks and how they can impact your option trading decisions. You'll learn about each of the Greeks, their importance, and how they impact option prices and strategies. Whether you're a seasoned options trader looking to sharpen your skills or a newcomer eager to unlock the secrets of successful options trading, this video will equip you with the knowledge and tools you need. So the Greeks, the main option Greeks are Delta, Gamma, Vega, Theta, and Rho. We're going to go through each of these now. So delta measures the rate of change in an options price given a $1 change in the underlying asset price. Think of it as a gauge of how sensitive your option is to movements in the stock, index, or other underlying asset. Delta values range from 0 to 1 for call options and from 0 to -1 for put options. A call option with a delta of 0.5 indicates that for every $1 increase in the underlying stock price, the option price is expected to increase by 50 cents. Conversely, a put option with a delta of -0.5 suggests that for every $1 increase in the underlying stock price, the put option price is likely to decrease by 50 cents. Understanding delta is crucial because it can provide insights into how an option will behave when the underlying asset moves. A delta of 1 means the option price moves in perfect harmony with the underlying asset. If the stock goes up by 1, the call option price should also increase by $1, with all other factors being equal. And a delta of 0.5 signifies that the option price will change by 50 cents for each $1 move in the underlying. Of course, that delta changes over time due to gamma, which we're going to look at shortly. Before we do that, I just want to talk about position delta, which is a really important concept to understand and a really important metric to follow in your trading. So each option strike has its own delta, but we also have what's called a position delta. Position delta is simply the option delta times the number of contracts. So for example, we've got some data here from Apple October options. The first one there, we've got a 170 strike put option, and we've looked at selling one of those contracts. So we're selling a put option. The delta of the put option is -0.1896. When we take contracts times delta, negative times a negative, we actually get a positive. And we actually need to times that by 100 to get the position delta of 18.96. So -1 times the delta of -0.18 gives us a position delta of 18.96. Now that basically means that that option position at the moment is roughly equivalent to owning 18.96 shares of Apple stock. Looking at the next example, the 175 strike put, this time we're buying two of those put options. That one's got a higher delta, it's -0.32. If we take two contracts, plus 2 times -0.32 times 100, gives us -64. So fairly obvious to some, when we sell a put option, we've got positive delta. When we buy a put option, we've got negative delta. And you can see how that's calculated there. Same with the calls. We've got a 175 strike call, buying two of those at the 68 delta. 2 times 0.68 times 100 is a position delta of 137, roughly equivalent to owning 137 shares of Apple. Then the final example, the 185 strike call, selling two of those contracts at a 31 delta. We say 31 delta rather than 0.31 delta. It's kind of a shorthand way. So even though the delta is 0.31, we kind of say it's a 31 delta call option. So -2 times 31 is 62 negative. So selling a call option has an overall negative position delta, even though the call option itself has a positive delta. What we can then also do is look at the combination of all those positions that we've got, those 4 positions, and we can look at our overall position delta across those 4 strikes and the number of contracts that we're trading. And overall, we've got a position delta of 29.32. So that, again, when we look at all those 4 options together in our portfolio, we've got a position delta of 29, roughly equivalent to being long or owning 29 shares of Apple. So understanding position delta becomes important when we talk about delta hedging. Delta hedging is a risk management technique commonly employed by option traders and market makers to neutralize or reduce directional risk in their portfolios. It involves taking an offsetting position in the underlying asset, typically shares of stock, to balance the delta of an option position. So taking that previous table where we had an overall position delta of 29, if we wanted to neutralize that delta, we could sell short 29 shares of Apple stock, and then we'd have an overall 0 delta across our portfolio. Let's look at another example. For instance, if an option trader is long a call option with a delta of plus 0.70, they would sell or short approximately 70 shares of the underlying stock to create a delta neutral position. By doing so, delta hedging aims to minimize potential losses resulting from adverse price movements in the underlying asset, providing traders with a more stable and predictable risk profile. So here we've got another example of an iron condor trade on Microsoft for the October 20 expiration. So the first 2 line items is the put spread side of the iron condor. We're selling 2 of the 300 puts, and we've got a long position of 2 of the 295 puts. And then on the call spreads, we're short 2 shares or 2 contracts of the 345 call, and we're long 2 contracts of the 350 call. So that's created our iron condor. It's an iron condor that we've been in already, and now the market's moved up. Because we've moved away from the center of the iron condor, we're showing negative delta overall. So the first column here for delta is the actual delta of the strike, and then this is our position delta. So you can see that 2 times negative 0.07 times 100 is 14. Selling 2 puts negative, so negative times a negative is a positive of 19. We sum all of those up and we get an overall delta of negative 9. So at the moment, this iron condor is roughly equivalent in terms of our directional exposure to being short 9 shares of Microsoft. Now, if we wanted to delta hedge that position, what would we do? Well, we would buy 9 shares of Microsoft stock. The stock position has a delta of 1, so basically 9 times 1 is a delta of 9, and that perfectly offsets our position delta of the iron condor. Now our combined position has a delta of 0, and we haven't impacted any of our other Greeks. We're still getting positive time decay through Theta, which we'll talk about shortly, and we haven't changed any of our Vega or Gamma, any other Greeks. Now that's not necessarily something you might want to do, but I just wanted to show that to illustrate how it's done. And now we've got a really flat T plus 0 line. That's this purple line here. We call that a T plus 0 line. It basically just means how does the trade look as of today, or trade date plus 0 days. And then the blue line is the profit and loss of the trade at expiration. So let's move on to Gamma. Gamma measures the rate of change of delta in response to a $1 movement in the underlying asset price. An option with a gamma of plus 0.05 will see its delta increase by 0.05 for every $1 move in the underlying. So our delta never stays the same, it's constantly moving, and that's measured by a gamma. So likewise, an option with a gamma of negative 0.05 will see its delta decrease by 0.05 for every $1 move in the underlying. Now, gamma is probably one of the less common Greeks. If you're fairly new to options, you may not have a great understanding of gamma. You might understand delta, theta, and maybe even Vega. Gamma is probably one of the harder ones to understand, but we'll go through a couple of key points about gamma and a couple of things to look for. So firstly, gamma is the highest with short-dated options and also at the money options. So they have the highest gamma exposure. For this reason, the last week of an option's life is referred to as gamma week. So you might have heard that term before. A lot of traders do not want to be short gamma during gamma week. So if you're short gamma and the underlying makes a big move, you're going to see your P&L suffer quite badly in those last few days. So short-term trades have a lot of gamma risk, or basically price risk. So just keep that in mind. Net sellers of options will be short gamma, and net buyers of options will be long gamma. This makes sense because most sellers of options do not want the stock to make a big move, while buyers of options benefit from large movements. So you think about someone selling an iron condor, they're selling options, they're going to have negative gamma. They don't want the stock to move too much. They want it to stay pretty steady. Same with if you're selling a short straddle or a short strangle, you don't want the stock to move around. You've got negative gamma. Conversely, if you're trading something like a long straddle or a long strangle, you've got positive gamma. You do want the stock to make a big move. A larger gamma, both positive or negative, leads to a larger change in delta when your stock moves. Low gamma positions display a flatter risk graph, reflecting less fluctuation in P&L. We'll take a look in a minute. High gamma positions display a steeper risk graph, reflecting high fluctuation in P&L. So here we've got an example of about a 3-week short straddle on Apple. So we're selling the roughly at the money call and at the money put. And we've got quite high gamma. We've got negative 93 gamma. And that makes sense, right? Short gamma, we want the stock to stay pretty flat. We don't want it to move around a lot. So shortish term trade, high gamma. If we compare that to a longer term trade, going out much further in time, out to March next year, still roughly at the money, a very similar trade, just slightly off center, much lower gamma. And you can see the difference in the T+0 line, that purple line. If Apple goes, let's say, to 180 today, we're going to be down about $2,500. And if it goes to 150, we'll be down $2,500 on the downside as well. If we compare that to the previous one, if we go down to 150, we're down well over 14,000. And if we go up to 180, we're down similar 2,000 to 3,000. But a lot more negative gamma. We're going to lose a lot more money if the stock makes a big move on these shorter term trades. So that's one of the main things to keep in mind when it comes to gamma. Short-term trades have the highest gamma or price risk. The next one we're going to look at is Vega. So Vega measures an option's sensitivity to changes in implied volatility. When implied volatility rises, options tend to become more expensive because there is a greater likelihood of significant price movements. Let's look at a stock priced at $50. So the underlying stock's at 50, and we'll consider a 6-month call option with a strike price of 50. So stock's at 50, we're looking at a 6-month call at the money with a strike of 50. If the implied volatility is 90, the option price is likely to be somewhere around $12.50. If implied volatility is 50, the option price might be around $7.25. And if the implied volatility is 30, the option price is going to be about $4.50. So you can kind of see the relationship here. When we have high volatility, we have a high option price. And when we have low volatility, we have a low option price, with everything else being equal. So Vega tells us how much an option price might change for a 1% change in implied volatility. For instance, if an option has a Vega of 0.3, it implies that if implied volatility increases by 1%, the option price will increase by about 30 cents, assuming all other factors remain constant. Understanding Vega is crucial for managing risk, especially when trading multiple option strategies. A good idea is to trade a combination of short Vega and long Vega strategies. You don't necessarily want to be all short Vega, because then if you get a big volatility spike, that's going to hurt all of those positions. We kind of use the terms short Vega, negative Vega interchangeably. It kind of means the same thing. Negative Vega, short volatility, it's all kind of the same thing, just a different way of saying it. So some short Vega strategies include short straddles, short strangles, butterflies, iron condors, and credit spreads. Long Vega strategies include long straddles, long strangles, calendar spreads, and debit spreads. So not only is it a good idea to have a mix of positive and negative delta trades, it's also a good idea to have short Vega and long Vega trades as well to hedge some of that volatility risk. Let's talk about Theta. Theta measures how an options price changes with the passage of time. Theta tells you how much an options price will decrease with the passage of 1 day. For example, if an option has a theta of negative 0.05, it means that the options price will drop by $5 per day, all else being equal. A positive theta value means the option position will benefit from time decay, whereas a negative theta value means the option position will lose money from time decay. To work out our position theta, it's very similar to how we did our position delta. We can take the options theta times the contract times 100. So using our same example from before, we've got our Apple positions that we were looking at earlier. We've got the 170 strike put, where negative contract, we're selling one put. The theta is negative 0.085. That gives us a position theta of 8.5. That means that option is going to decay by about $8.50 per day, with all else being equal. Notice that the actual theta is all negative because all options lose value each day, and it just depends whether we're long or short that option as to whether our position theta is either positive or negative. So if we take the second line, the 175 strike put, and we're buying two of those options, the theta of that option is negative. We take 2 times the negative 0.07, gives us negative 14. We're going to lose about $14 per day from holding that option, that put option. Same with the call option. We're long 2 contracts. Positive times the negative is still negative, losing $18.80 per day through time decay. Selling the call option, negative times the negative is positive. We're gaining $5.20 per day from theta. And then overall, we can look at our overall position theta is negative $19 per day. One of the characteristics of options is that they have a limited existence, as they are contracts which contain a beginning and an expiration date. As the expiration date of the options contract approaches, the value of the contract will change more dramatically. Some of you may have seen similar images to this. We can see that this is showing us the time decay of an option. When we've got 180 days to expiration, there's a lot of time decay, and it's not really losing money that quickly. But then when we get down to the last 30 days, the time decay really starts to accelerate and gets much faster. So that's what a lot of people are doing these days, is trading very short-term options and selling those options, trying to take advantage of this huge time decay that happens, particularly in the last week and the last few days. The trade-off, of course, as we looked at earlier, is you've got gamma risk. So theta and gamma kind of go hand in hand. If you've got a very high theta because you're trading short-term contracts, you're likely to have very high gamma or price risk as well. For buyers of options, theta represents a daily cost that must be overcome by price movement or changes in other Greeks to achieve profitability. Option sellers, on the other hand, aim to profit from time decay while trying not to suffer the negative impacts from the other Greeks. Strategies that benefit from time decay include short straddles, short strangles, butterflies, calendar spreads, iron condors, and credit spreads. A common question that comes up, particularly from beginner traders, is do options lose value over the weekend? If we know that options are decaying every day, can't we just sell them on a Friday and buy them back on a Monday? That's what people ask. So let's discuss that. Unfortunately, it's a very common misconception among beginner traders. They think they can just sell the options on the Friday, buy them back cheaper on the Monday. In reality, the weekend time decay effect has already been priced into option values as early as Thursday afternoon. So back in the 80s, when options were fairly new, weekend time decay probably did exist. But there's some pretty smart people who came up with options, and the market makers even back then, they twigged onto this pretty quickly, and that edge disappeared very, very quickly and certainly a long time ago. So do options lose value over the weekend? Yes, but not as much as you might think. The last Greek we're going to talk about is rho, and rho measures how much an options price is expected to change with a 1% change in interest rates. Specifically, it quantifies the impact of a change in the risk-free interest rate on an options premium. Rho is more relevant to traders of long-term options and less relevant for short-term options. It's probably one of the least important Greeks. It's positive for call options and negative for put options. So interest rates going up, that's good for call options and bad for put options. So this means that call option premiums tend to increase when interest rate rises, while put option premiums decrease. In practice, though, rho's impact is generally less significant than delta or theta for many option traders. However, it has become more relevant in recent years given the significant changes in interest rates that we've seen. So to recap what we've learned today, delta measures the sensitivity of an options price to changes in the underlying asset price, helping traders assess directional risk. Gamma measures the rate of change of delta in response to a $1 movement in the underlying asset price. Vega measures the impact of changes in implied volatility on option prices. Theta measures the time decay of an option's value. Rho is the least important Greek, but measures the influence of interest rates on option prices. If you enjoyed the video and found value in the insights shared, please give it a thumbs up and share it with your fellow traders. Thanks for watching, and I'll talk to you soon.